Welcome to the Colliers Podcast. I'm Robert McLean, and I'm really happy to be continuing with the new series of podcast episodes on the Czech, Slovak, and Central European property markets. Today on the hot seat, it's Kevin Turpin, Regional Director of CEE Capital Markets for Colliers. Hi, Kevin. Great to see you today.
Likewise, Robert. Good to see you.
Kevin, the reason we're talking today is because you just put out a new report for the first quarter of 2024 on the region's capital markets. So let's get into that. But before we get into Q1 and your predictions for the rest of the year, let's take a look at what happened last year when it comes to real estate transactions. What were the major deals that took place, and what was the total volume?
Sure. Yeah. No. The total volume for the region last year, for the CE region, was 5.2 billion, which in rough terms against the year before was down about just over 50%. Which is roughly in line with what we've seen across the rest of Europe and the globe. For the Czech Republic, the total volume was just over 1 billion at 1.15 billion. And some of those largest deals, the largest was in Romania. It was the Matiska retail warehouse portfolio sold to MCOR for around 220 million. Then there was a Tray portfolio across Czech Republic and Slovakia. Mm-hmm. Majority of those assets, supermarket assets in Czech Republic. That sold to Plan B Investments for around 215 million. Then 7R sold a large proportion of its shares to NREP in Poland for around 200 million. And finally, one of the other largest ones, again a retail deal, Palác Pardubice, sold by G-City to Redside for around 125 million.
Okay, now how would you rate 2023 compared to 2022? I mean, looking at the numbers that Colliers produced, it seems like 2022 may have been the last big year for transactions. Is it fair to say 2023 was the beginning of a new chapter for the market?
Yeah, I think 2023 was where we've seen obviously a big drop off, similar to what we saw after the global financial crisis, a big drop off in volumes. So 2021 and 2022 both at a level of around 10 billion. Which was slightly down on let's say the few years prior to that, and that was largely because of COVID and the fact that shopping centres and hotels were closed, so they were just not trading at all. So those results in 2021, 2022 were actually quite good, considering that some of those large ticket items weren't selling. And then obviously fast forward to 2023. It significantly dropped off, largely due to the cost of finance and a few other factors.
Looking through your report, you asked the question, are we there yet? Could you explain what you mean by that question and, of course, what the answer is?
Absolutely. So it's with all the sort of crises and challenges we've been having in the market, it's a bit like going on a long journey with children and they just basically want to know when they're going to arrive. And it's similar with the markets. We want to know when, the market's going to bottom out and things are going to, take an upturn and things will get active again. So, I think while we feel we're getting close to the bottom of the market, we're just not quite there yet. I think that's the message.
Right. I mean, there's usually two things going on. It's not just volume, but that's often an expression of price and whether people agree on the price.
Yeah.
I think we're going to get into that kind of question, but why don't we start by looking forward into your personal crystal ball then, or your company's. Your report predicts volume similar in 2024 to last year. 5.2, maybe 6 billion, I think you say in your report. If I could push back on that figure, though, I wonder if the assumptions driving it aren't based on expectations of significant reductions in interest rates for the euro. I mean, look, as recently as a month ago, we expected big rate cuts in the second half of this year. I'd argue that a rethink by the American Fed may be underway, and that could have a knock-on effect in terms of the ECB not reducing its rates as much. In other words, are the predictions maybe a bit optimistic in terms of lots of volume because they're assuming that there's a rate cut coming?
Yeah, I think that there is an element of that. However, we have seen a couple of large transactions take place at the beginning of this year, which some have already recorded, some will be recorded next quarter. So that's a good start to the year. But yeah, I think there is the expectation that rates would certainly help move things along towards the end of the year. But yes, as you mentioned, with the Fed, perhaps stalling on where it's going to take rates to, or slower increments, that will certainly impact on what the ECB does as well.
Okay, now the Czech Republic is looking increasingly like an island of yield stability compared to just about everywhere else in Europe, whether it's you're talking about UK, Germany, even Polish yields have risen considerably more than they have here. Is that mainly down to the strength of domestic investors?
It certainly has some way, does certainly play a part in it. Czech domestic capital is very strong. It's very keen to invest in its own market where those opportunities arise. So there is an element of that, but also, again, there's been a lack of transactional evidence in most of the sectors, so it's very, very difficult to sort of pinpoint where that may be. Poland certainly has shifted a little bit further than Czech, or at a faster pace, perhaps more in line with some of the Western European countries. And again, that will hopefully demonstrate a bit of a bounce back later in the year.
I mean, I don't have to tell you, when I talk to foreign investors, they have really raised eyebrows, I would say, when they get quoted what the prices, and that there is this stability, relatively speaking. Is it sustainable in your view?
I mean, another way of looking at, there are some good fundamentals in the Czech market. If you look at Prague has one of the lowest vacancy rates in Europe. Rents are relatively stable and slowly increasing. There's a low level of supply. So there are a number of factors involved in the office market, in the retail market, in the industrial logistics market. Some of the fundamentals to support that. But yes, you can understand that if there are opportunities now in Germany to buy almost identical product at around 5%, then why would you spend 5.5% in the Czech market? There's many arguments for and against it. Mm-hmm. But yes, I can understand why some investors might raise an eyebrow too. But then there are groups of local capital that will absolutely have no problem with that.
Right, and we'll take the heat off a little bit in terms of pricing, at least for the moment. Tell me, which sectors are you seeing the most interest for right now?
So I think, I don't think it's a secret that a lot of investors still, given the choice, will want to invest in industrial logistics or beds, so effectively beds and sheds.
Right.
With industrial logistics, the withholding factor is that majority of the players in the market are long-term holders, so there's not an awful lot of product that comes to the market, and of course that helps keep pricing where it is. It's a little bit more competition when it does come to the market, and in terms of PRS or rented accommodation, again, that product needs to be developed and delivered and stabilized before it becomes an investable product. And there's also the slightly added complication that most of the income is collected in Czech crowns. So there's a few things there. But again, there are domestic buyers that will like that. So there's a market for it. So those are the two. Offices definitely softened, given the hybrid scenario that we're in, and then retail is largely, with the odd exception, with the example of Trigia, retail parks, supermarkets, very much in demand.
Now, since you have your regional hat on these days, Poland doesn't have the same sort of domestic real estate investors, as you were saying. What's the impact of that on the Polish market in terms of the dynamics?
So in terms of dynamics, Poland, with the lack of a REIT structure or similar qualified fund structures that the Czech Republic enjoys, it roughly translates into the fact that 98% of all investment or all capital comes from outside of Poland. In contrast to the Czech Republic, where depending on the year, over the last 5 years, roughly 50% has come from Czech capital alone, and increasingly more as you look at individual years, most recently. So it's a struggle, and as I said, in the first quarter of this year, Czech volumes are higher than Polish volumes on the rare occasion, and and increasingly Poland's having to look elsewhere. So we've seen capital come from the Baltics, Scandinavia, for example, but certainly the sources of capital are far reduced at the moment for Poland. But we believe that they'll bounce back once a few things fall into place,
including lower prices, perhaps.
Yeah, better interest rates, slightly lower prices, although they have shifted a reasonable amount, and of course, an ending to wars and various other challenges that are ongoing would also help out.
Just how tough are things in the German-speaking markets right now? I mean, there's a huge amount of distress right now among residential developers, from what I'm reading, and lenders are trying to pick up the pieces after the collapse of the Sigma Group. What are you hearing from your colleagues in Germany?
So I think from what we're hearing, it's quite a similar story. Of course, so on the development side, a number of developers are struggling. So they might be forced to sell projects or standing or completed assets in order to finance new ones if there's a lack of financing, either full stop or at suitable conditions. So I think for the first quarter of this year, it's up a little bit actually, similar to Central and Eastern Europe. But compared to 2022, it's down something along the lines of 70%. So while they feel that again that the markets are bottoming out, so pricing is already it's shifted quite considerably in some cases. So office yields were trading just below 3%, and they're now high fours, knocking on 5. So that's quite a shift in pricing. Of course, the availability of debt and the belief in those sectors, whether you can get behind offices, for example, is a bit of a challenge. But it's definitely been shook.
Yeah, I think when you look at the rise of the domestic investor in Czechia, I can see it either as it's either a glass half full situation or a glass half empty. I mean, of course, it's amazing that there's so much available liquidity here from Czech investors, but I just find it concerning that the market here and potentially even in Poland is just so reliant on it. And when you look at the situation in Germany, I think that's showing what's going on elsewhere and why there's this lack of interest elsewhere. I guess I just wonder do you think it's a good sign that the Czech investors are so strong here, or does it worry you in terms of the sustainability?
Like I said, domestic capital had not played a strong role in the past, just simply because it wasn't able to compete, with Western or Western capital or capital from other parts of the world, and now it can, and it's not just because it's not of course some of those investors have disappeared, so it's good that they're there. Otherwise, those volumes would be significantly lower.
Right.
That money is being raised here, and therefore that money is keen to invest in its domestic markets. It understands the markets. It's close. It can manage those quite easily because they're here. So it's good that they're there. I think they are able to compete. They're able to do small to large transactions. As I said, I mentioned earlier the Tragia acquisition of Arcadi, like I said, I think the Western capital will come back. Once things stabilize. So they're enjoying their time. And they will have the liquidity at the other end, the other way around. So I think it's a great opportunity for them to acquire real estate at good prices. Real estate they understand and they can they get their heads around. So so why not?
Maybe if I could just try one final question on you, and I realize this is a huge topic, but if we could at least touch on it. ESG has become a major factor for all investors for financing, and I think it's going to throw a wrench in the works a bit in terms of deals. In any case, it is changing the background of deals. What are you seeing as the impact of strict following of ESG regulations on the market?
Yeah, so you've got a couple of different types, of investors. So, those that follow it very, very strictly and need to, depending on the source of their money, and those that are less so. But yeah, overall, it's I think most people, most serious players in the market understand that complying with ESG requirements, regulations, and so on and so forth is the right thing to do, and it's also in line with an increasing rise of requirement from occupiers. So, of course, a lot of those regulations depend on how large you are, large the occupiers are as an organisation, and gradually that will increase in volume, or the requirements will be smaller for the smaller companies. And of course, the banks also, for the first time this year, need to start reporting on their green asset ratios. So there are pressures. The challenging part for everybody involved is that if you've got a building that is not or doesn't have the highest or meet the highest criteria, certainly money will need to be spent on that. The question is where's that money going to come from? If you need to borrow that money, it's going to cost you a lot. And it comes at one of the most challenging times that the real estate industry's been facing for a number of years. So, but having said that, it is proceeding, it is progressing. Is it having an impact on some deals being closed? Quite probably, yes. But again, with the volumes that we're seeing at the moment, it's just difficult to tell.
Kevin Turpin, thanks for your time and your insights.
You're very welcome. Thank you.